The gold prices are trading higher today after dropping nearly 3% in the previous two sessions. But the sentiment remains fragile on rising expectation of an early end to the U.S. monetary stimulus and on accelerating fund outflows. The metal is headed for its first annual decline in 13 years as investors buoyed by a recovering global economy channel more money into the riskier assets such as equities by pulling funds from safe haven gold. On your screen, the slight green coming in the Indian as well as the international markets there. The Brent crude oil prices in the meanwhile also are continuing to trade below 110 a barrel as traders eye a restart of ports in eastern Libya while also looking ahead to the Fed meeting for any changes to its massive stimulus program. Let's bring on board also Wwatch. He's AVP Commodity Research Bonanza. Vibhu, hi, welcome to you first then. And how are you looking at the crude oil prices? Because that's the only positive sector for this year which has seen good gains coming in. This month also has been positive. This week, of course, is slightly in the negative. But how would you want to trade at these 6,000 odd levels?
Definitely some positive fundamental news for the energy pack. I think the firstly US data that is quite attractive. What we can say it's either it's a jobless data or we can say retail data that was quite fantastic, which will increase the demand prospect from the largest consumer of the US. Also the inventory is dropping down since last few weeks. That is also supporting the crude prices. The only thing which is hurting is might be a stimulus rollback from the Fed side. That might be pressurizing the crude prices. But I think the scenario will remain somewhere around 61102. I can say somewhere around 6,000 level for the meanwhile till we got a clearance from the Fed side. Above 6110, I am looking extremely bullish for somewhere around 6200 or above level in the very short while.
Vijay, how would you look at the natural gas prices? Even as we are trading negative for the crude oil, it's the natural gas prices which have been positive today, the whole of this week and the whole of this month for that matter.
Manisha, I would stick to my view that natural gas, as I mentioned even yesterday and day before, is possibly likely to head to the 278, 280 levels before seeing some kind of serious overhead supply capping the gains for this month. I think 280 to 282 band is somewhat of a serious resistance point on the chart, and there I would expect a lot of longs to get unbound. The possibility of shorts also emanating at that level remain fair. So as the price heads towards the 278, 280 levels, I would advocate lightening up on your long positions, taking some money off the table and taking a fresh view only in the month of Jan, because from here on, the price, the volume and the open interest have to rally in tandem for the rally to be really sustainable, failing which any kind of advances might just terminate very abruptly.
Vibhu, how would you look at the gold prices? Because that is one space that has been choppy as well. We've tried being around that 1260 mark, but we always come down to those 1220 levels. So it has really been between this $30, $40 that the gold prices have been trading.
Definitely. 1260 is, in fact, $1,300 is not sustainable because of, I think, the major reason is sentiment is quite weaker for the precious metals, as well as we had clearly seen is in its ETF, SPDR, which is the largest ETF. We had seen since last, I can say, since last 1 or 2 months, the holding of ETF is continually dragging down, and that is the pressurizing the precious metal prices. Even though yesterday we had seen a very good sell-off in the ETF also, once we get a bounce back. So I think this will be hurting the sentiment as far as the Fed is concerned. That is also hurting the sentiment. I think the domestic scenario also technical, it's also looking on the downside only. So I think before a Fed conclusion, I am not surprised if we can get somewhere around 1215 or 1220 levels again in the very short while.
To silver then, and $20 an ounce seems like a difficult level to keep above on, Vijay.
Absolutely right, Manisha. I think both gold and silver are likely to remain under pressure. I would still maintain staying away from the leverage space, and any fresh buying should be contemplated only near the 42,500 levels. As long as that level is not being reached, I would sit on the fence. And bullishness will return to this metal only above 45,700, preferably even 46,000. So unless the 46,000 is overcome, and that too very forcefully, I think any rally would just flatter to deceive.
To the base metal space, then, it hasn't been a very good week for that one yet again. The Monday and Tuesday days were good. The sessions did see some gain coming in, and we did see copper prices going up all the way to those one-month highs there, but it hasn't been able to sustain that, and we have seen declines come back. Vibhu, how would you look at something like a copper and a zinc in the markets to play today?
Definitely. We had seen a good rally in the base metal peg since last 2 or 3 days. The major reason being this, I think supply crunch is there. Very short-term supply crunch is there. Apart from this, quite a fantastic US data is supporting the base metal prices. Beyond, I can say, for the medium to long run, still the pressure is builded on the base metals peg because of the higher inventory, because of the lower lower demand expected from the China side, largest consumer China side. So I think for the short while, we need to look after the copper also, we need to look after the zinc also, because zinc has also already traded above its very nice breakout level. So I think copper might, I'm not surprised if we can get copper somewhere around 468 level in the very short while, or I can say zinc somewhere around 123 or 124 odd level.
Vijay, while we are looking at aluminum, copper, zinc, all of that trading steady, it's only nickel that really catches your eye, 0.25% down in the Indian markets yet again.
Manisha, the 878 level that I talked about has proved to be the nemesis of an average bull. The prices are unable to go past that, and what I suspect is that smart money is really watching the after effects of the Walker rule. Now, if Paul Walker's rule is restricting big ticket banks from commodity exposure, my guess is the liquidity is likely to suffer a little bit. Along with that, the exposure of hedge funds, by and far the largest players in the commodity space, will also get impacted slightly. So I would maintain my view that in the last couple of trading weeks that I've been talking about, I see signs of deleveraging in the industrial metal space. There is no urgency or no sense of greed on the screen where a trader is showing signs of, if I don't buy today, I may have to buy at a higher price. Unless that urgency returns on the screen in terms of price, volume and open interest, I don't see how prices can sustainably go higher from here. I think we are running into a brick wall. Unwinding and deleveraging seem to be ruling the roost.
To the agro space, where the guar seed futures rose today on short covering, supported by an improvement in spot demand. Those supplies from the new season crop and prospects of higher production restricted the upside there. The industry experts feel that the guar seed production in 2013 could be around 2.5 to 2.7 million tons, which is up nearly 2.2 lakh tons from the year earlier. The chana prices also have gained today, tracking firm cues from the local market, though ongoing sowing operations and higher stocks capped the gains. Sugar, in the meanwhile, saw some recovery after a long losing streak as export prospects brightened due to buoyant demand from countries such as Iran. Mills have been swarmed by massive stocks as India is set to produce surplus sugar for a 4th year in a row. The soybean prices, though, have seen a decline. The soybean is at the lowest level in 1 week on expectations of higher supplies in coming weeks, while soya oil hit nearly lowest in 7 weeks. For more on the space, let's get in Sandeep Bajoria, who is CEO Sunwin Group, and he joins us on a Mumbai phone line. Mr. Bajoria, hi, welcome. How have you seen the commodity move? I mean, it's trading at multi-week lows at this point in time with what the rupee is doing, or do you think it's majorly about the international cues?
Manisha, it's majorly about international cues. Rupee had softened down from 64 to 61, but again now 62.10 today. But majorly now the international market is softening down because of the pressure of soft oil is building up everywhere. We have a big South American crop in soybeans, 7 million tons in Brazil, 55 in Argentina. And then we have big canola crop in Canada. And on the top of that, we have a big sunflower crop in Ukraine and Russia. All this put together, soft oil space is really under pressure, and we have seen about $40 soft oil is lost in last 1 week. And palm oil all the time was holding, but now because the pressure from soft oil, palm is also cracking now in last 2 sessions, and today also we saw palm oil coming down 50 ringgit. So CPO is being traded around $860, and soya is about $950. Sunflower is also $950.
Okay.
So with the international pressure coming in and demand is poor at this time of the year, Indian arrivals are good. Kharif crop is in the market in full swing. We have good arrivals of cotton, rice bran and soya locally produced. Hence, because of the lower demand and enough stocks available in the country, and international space looking little on the downside, market is shedding gains, in this and last 1 week.
So what's your sense going forward from here? With these kind of bearish cues, do you think there's more decline coming in?
I believe we are not done yet. However, maybe not more than the best $15-20 can decline from this stage, and then the market will consolidate thereafter. And again, there could be a possibility in something around end Jan or Feb market looking up.
All right, Mr. Bajoria, thank you so much for joining us with your sense of some more decline, and the market could start looking up only after a month. Vijay, what's your sense, though, coming in for the spices space? Because whether it's jeera, cardamom or turmeric, these three commodities actually seem to be looking quite buoyant today.
Manisha, trading is happening in a very sporadic manner. It's pulses on one day, it's grains on the other, and then spices on the third. There is no secular trend emerging anywhere which could talk about an urgency of traders to go on the buy side. Here again, I think as we approach Christmas, there is a sense of taking very short-term views. No trend is lasting beyond 2 or maximum third trading session. So if at all you are a high-risk appetite trader, you might want to take a punt on the long side on an intraday basis, but I would feel more comfortable squaring up the trade by the end of the session rather than rolling my longs forward.
How do you see the gain up coming in for the pulses prices?
I'm bullish on chana, I'm bullish on sugar, and I think as we head towards March end or April, you will see chana prices. I would maintain since more than 2 months now that 3375 is a level I'm expecting by end of March, maybe mid-April 2014. So I would have a tendency to dip for bottoms in the mid to far month futures. Anytime the prices go decline more than 1.5%, maybe approaching 2%, I don't really mind going long on the mid and far month futures.